But when you're considering ownership structures, when you're considering trust, when you're considering companies, when you're considering how you actually hold your assets, I think it's really important to involve a few various people, a financial advisor, a lawyer, and an accountant, so that you're getting, from a legal perspective, the implications from an asset protection. You're getting that from a financial advisor, as well as how that fits into your wealth strategy. And then the accountant's also overlooking it to make sure that it's tax efficient.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are back again talking about more things to do with finance and more things to do with money.
Andrew, we absolutely love this. We could talk about this underwater with a mouthful of marbles. Mate, can't wait.
We probably do.
Can't wait to rip into this because I think this is a really good one and I don't think it's often enough spoken about.
Yeah.
Andrew.
Until it's too late sometimes.
Or thought about until it's too late. Absolutely right. So Andrew, let's lead us in. What are we talking to everybody about today?
Yeah, so today we are talking all about asset protection. So we spend a lot of our day talking about building wealth. We spend almost all of our day and all of our time talking about how to accumulate assets, grow your asset base. And often, as we sort of alluded to already, people forget about, okay, I've accumulated these great assets. How do I protect it? Because the more assets that you have, the more that someone wants to come and take a slice of the pie.
Or the more you have to lose.
Oh, exactly right. Yeah.
Before we get into it, I might preface this thing with two things in our experience.
Yeah.
So asset protection, there's probably two areas that I've observed that you can't protect your assets from.
Yeah. Right. Which is usually the first thing that people come to us to talk about.
First or second, depending on where you're at. But so the first one is family law, right? So in the event that you're in a relationship and something is going untoward, you cannot protect your assets by moving them around and bits and pieces. Family law trumps everything.
Yeah.
So that's probably one thing. And, we're not going to get into detail because we're not experts and we can't give advice in that area. But from my experience, family law is always one of those areas that asset protection does not work. So that's probably the first thing. And the second thing is when we talk about creditors, and especially with, we'll say the banks, when you've borrowed money from them, they have obviously a lot of experience in terms of structuring deals and finances and bits and pieces. It's very, very difficult to try and protect your assets from a bank if you owe them money. Yeah. But we'll talk about that in a little bit of detail. Maybe you only give them security over certain assets and move the rest of them. That's a different story. But look, we'll get into it. Andrew, what's the first thing that we sort of think about when we're talking about asset protection?
Yeah, so when we're talking about asset protection, one of the first things that we sort of talk to our clients about and think about is having a separation between your business assets and your personal assets. So generally speaking, we're talking about someone here who's potentially self-employed. You're self-employed, you've got a whole bunch of assets, whether that's your intellectual property, whether that's your recurring revenue, whether that's business, real property, whatever that is. Having a separation of those assets from your individual assets versus the assets that are held within the business is one of the first things that you consider, because you don't want, if touch wood something happens and that business falters, you don't want to expose all of your assets to creditors in essence, if something untoward were to happen to that business.
Yep. So I might just unpack that a little bit as an example. So we're in business together. If we go and borrow money from the bank for business purposes and for whatever reason we can't pay it back, that's what I was referring to before. That's going to be very difficult to protect our assets from that, because if the bank's lending you the money in the first instance, they're going to want to make sure that they've got the security in order to do it. I think from a business perspective, where this really ends up is if you're using, trade credit where you're buying material from another supplier or from a supplier or something like that, if something happens to the business and the business goes belly up, you don't have the liability does not stay with you as the individual, it stays with the business, which means that whatever assets that the business has got, or you've got personally, I should say, is outside of that equation. So I think just separating the two, that was a really good example in terms of the bank versus, I guess, different types of creditors in this instance.
Yeah. So one of the ways that, what you can do it when you're talking about separating personal assets from business assets is, take a consideration of a spouse who maybe is an employee, who maybe doesn't have the risk associated with, a business that ultimately that may falter. You obviously don't go into business with that intention, but holding assets in a spouse's name who doesn't have as much risk associated with their occupation is one way to be able to have a separation between your personal assets and your business assets, taking into account, and there sometimes with all of this is a consideration from a tax side of things, their taxable income and what implications it's going to have from a tax perspective. So for instance, if your partner is high income earner, an employee, you want to hold assets in their name for asset protection purposes, well, now all of a sudden you're holding assets in their name from an asset protection basis, but from a tax side of things, it's inefficient because all of the income associated with that asset is going towards their taxable income, and so you're paying tax rates at a higher tax rate. So you really need to be able to balance the tax as well as the asset protection side of things, which maybe is where the next point comes in.
Well, there's no silver bullet here, and kind of using a spouse's, holding assets in a spouse's name kind of then throws back to sort of what we were talking about before. It makes no difference from a family law perspective if that relationship breaks down. But just sort of dialing back a little bit, Andrew, one of the examples that you were giving is in the event that, say, your business went under. It may not even be something like that. It could be something like, one day you're driving home and you fell asleep and you're negligent because, you didn't pull over and rest or whatever it is, and something happens. There's pain and suffering and loss associated with that accident. Somebody realizes that you've got assets within your name, so they pursue you personally for that. That could be a perfect example where there's not a business transaction involved, but if assets aren't in your name, then that could be a perfect example of what that looks like.
Yeah, absolutely. Second thing, we've all maybe heard about it, but trusts, how does that work? Is it beneficial?
Yeah, so basically having assets in a different structure, in a different entity. So having them removed, one step removed from you. So in a trust instance, you or your spouse may be the controller or the appointer of the trust. So ultimately you can decide what happens within that. But from a legal perspective, you're not the legal owner. So it just creates that separation one step further in order to be able to then do that. And we can also play on what you were talking about before, about from a taxation perspective. So if those assets are producing income, if it's in a trust where you can distribute income, it also gives you the ability to be able to then choose who gets that money and potentially moving money into the lower income earner's name to try and get a tax advantage with that as well. But having a trust as an owner of an asset is definitely a consideration that we talk to people about all the time.
Yeah. And maybe playing on the tax side of things as well, just because it's an important consideration, particularly when you're talking about property through a trust. I mean, one, there's the implications of cost, and so stamp duty is different, generally more expensive when it's held within a trust. Your land tax is generally more expensive when you're holding property within a trust. But one of the other things that sometimes people can forget about is a trust is able, or a trust must, distribute all of its profits each and every financial year. But a trust cannot distribute its income losses. So let's say you're talking about a negatively geared property, which is very commonplace at the moment, especially while interest rates have been rising. You've got an asset that's producing a tax deduction, so to speak, or a negatively geared asset. A trust can't distribute its income losses. And so as a result, you're not actually getting any benefits of negative gearing when you're holding a property that's negatively geared through a trust. So really, it's probably a podcast episode all in itself. But when you're considering ownership structures, when you're considering trust, when you're considering companies, when you're considering how you actually hold your assets, I think it's really important to involve a few various people, a financial advisor, a lawyer, and an accountant, so that you're getting, from a legal perspective, the implications from an asset protection. You're getting that from a financial advisor, as well as how that fits into your wealth strategy. And then the accountant also overlooking it to make sure that it's tax efficient is ultimately really important when you're considering these things.
And I think the other call out is as well too, in our experience, you want to get this right at the start before you purchase an asset. If you don't get the structure right and then decide to transfer assets from, say, your personal name, in this instance, to a trust, you're changing beneficial owner or ownership. So you are going to trigger things like capital gains tax, if applicable, buy-sell cost depending on the asset, stamp duty if it's if it attracts stamp duty. So getting it right at the start is such an easier exercise. So it's kind of, you need to get the advice beforehand rather than after the fact, because it all sounds great, but if you don't do it at the start, you may just recognise that the costs are too high to actually then transfer a particular asset down the track. So I think getting in early, getting those people that you were talking about, those different professionals involved, and making sure that you've got the right structure, the right strategy, and you execute it correctly is definitely the way to go, because if you don't, probably, in most instances that I've seen, especially if you're dealing with, more expensive types of assets, the opportunity is gone because it's too expensive to do the transfer and it's just done.
Yeah, exactly right. But it makes a difficult conundrum, because there's the costs associated with, if you're first starting out a business, or if you're first opening up a business, there's the cost of establishing that business. There's a time period where more than likely you may be not earning a profit or an income, and you throw this into the mix, it can make it quite difficult. But if the expectation is that this is going to become something that's going to be a serious business, that you're not just, doing a little side hustle that's going to earn a couple of grand a year and, is something for fulfillment rather than for profit, then you really want to be getting this right, because, as you said, the costs of needing to move it in the future sometimes make it too exorbitant, whereby it's just not worthwhile going down that route. The other consideration is you can overcook this. I've had clients that have come in, like government employees, have always been an employee, never going to be or never had any intention of being self-employed. They're relatively low risk occupation, so your likelihood of getting sued or pursued or anything like that is pretty damn close to zero. And they've got company structures, they've got trust structures, they've got bucket companies. There's all of this stuff going on.
It sounds good.
Yeah, which sounds really amazing and it's exciting, but you look at it and it can create not just issues when you're trying to set everything up, so the costs associated with establishing it all, managing it all, but then also you go to the borrowing element of it, and every time they apply for a home loan, it's this arduous process of it trying to explain to a bank and to a lender of, how much is being distributed, where it's coming from, and it's completely unnecessary. So not to say that there's no benefit in it when you're, an employee or anything like that, because there's definitely some benefit to be had, but understand how far you need to go and how far is just too far when you're going through this is another important aspect of it.
No, absolutely. And obviously not only just the cost associated with it, but the administrative burden. Yeah. And I tend to find that as we get older, we want more simplicity as well too. So getting that balance right is definitely one thing, but you wouldn't go down this exercise just because it sounds great. Yeah. You want to make sure that it's actually fit for purpose. And you're going to get benefit from it ultimately. Otherwise, then what's the point? So Andrew, I guess next thing, company structures is also another one for a trading business. So looking at things like a sole trader or a partnership where you're an extension, or the business is an extension of you. Yeah. So from a legal perspective, it's deemed one and the same. So setting up a company, if you're in business as opposed to a sole trader or a partnership, creates another separate legal entity as well too, which is something that we'd recommend all of the time. And I think the majority of businesses that we come across are run out of a company structure. They may be owned by a trust, but definitely from an operating perspective, company is definitely the way to go. We don't really see too much from a sole trader perspective, unless it's a really, like what you were describing before, unless maybe it's a startup business and people are just trying to figure out what let's start trading, let's see what happens. If I get some revenue, if I get some profit, great. Once you kind of realise that this can turn into a sustainable business, and a viable business, you tend to shift across to I imagine, a company structure. So that's probably a really simple one that we see all of the time, that creates that separate legal entity for an individual moving across.
Yeah, absolutely. Another one that's, I think massively underutilized, especially when people are self-employed, is superannuation, really as an investment vehicle. So you consider a lot of self-employed clients, they look at things and say, okay, for every dollar that I earn, if I put that back into my business, I can reinvest it, the business can grow, and I can earn a 50% rate of return on it, or not even just the rate of return that I'm going to get out of it, but I have direct control around what will happen with that money and how that's going to deliver a greater profit to me. So a lot of the times you forget about superannuation contributions because you're so busy reinvesting back into your business. Now, that can have an issue in that, is the business sellable in the future? So do you actually have an asset? But let's sort of park all of that to the side and just look at, from an asset protection side of things, when you're putting money into superannuation, it's almost one of or I would arguably say, the best assets from an asset protection side of things. I mean, creditors can't come after it. People that are suing you can't come after it. Really, the only thing that it's exposed to is a spouse. So in the event of a relationship breakdown. But other than that, it's one of the greatest assets that you can have when you're talking about asset protection. And completely negating that by just reinvesting back into the business is, I think you're missing a big opportunity there.
Yeah. Probably just the only other thing that I'd add to that, Andrew, is if it's deemed that you're using superannuation to shield assets from creditors that you owe money to, there's the opportunity for the creditors to be able to claw that back. But if you're using superannuation normally without that, without the intent to try and shield assets from creditors, then it's an asset that is not accessible for creditors. And like what you said, it's just family law that trumps that. If there's a relationship breakdown and that happens, superannuation does form part of the asset pool that gets looked at and that can get divided as part of a relationship breakdown. But from that perspective, I think you're right. It's the best investment and asset protection and tax structure vehicle that we've got available to us, that kind of is the thing that almost ticks all of those boxes as best as you possibly can.
Except for maybe liquidity. But other than that...
Well, except for accessibility and liquidity, I mean, obviously you need to
meet a condition of release to get it. But
a certain age and a certain status in order to access it. But yeah, you're absolutely right.
And the other thing, I mean, just to sort of expand on what Billy was talking about, is if you're using it regularly to shield assets, so it forms part of a greater asset protection strategy, no problem. What Billy's talking about is for instance, in the event of bankruptcy, superannuation is an asset that's protected. And so I had a consultation a few years back with a couple who were about to enter into bankruptcy. And one of the things that they were talking about was putting all of their assets into superannuation so that it's shielded and that liquidators can't take the superannuation money. And in that instance, what's going to happen. It happens in one lump sum just before you declare bankruptcy. It's very clear and obvious how you're utilising that vehicle. So yes, it can form part of an asset protection strategy when you're doing it prior to anything happening, but when the writing's on the wall and you're in essence going into it, that's definitely not an available opportunity for you.
I mean, look, good in theory, but it doesn't work out like that in a practical sense.
Yeah.
One of the other things as well too, from an asset protection perspective, thinking about ownership is things like investment bonds. Yeah. So if you open up an investment bond, and we've done a couple of podcasts on investment bonds, what they are, what the benefit is associated with them, but an investment bond is an investment that it's not held in your name. It doesn't form part of your estate, so to speak. That's something that's completely separate. So we also look at that as an asset protection vehicle that is not exposed to creditors in the event that something goes pear-shaped.
Yeah, absolutely. And in addition to that, you're talking about a tax-efficient environment. So you're almost getting... I mean, I like to look at these investment bonds almost as... It's almost like a superannuation investment. So almost, yeah. It's a little bit illiquid. There's some restrictions around how much you can put in. There's restrictions on how much you can draw or when you can draw the funds out. But there's tax benefits. There's some benefits in relation to asset protection. It's almost like a diluted version of a superannuation fund because the tax benefits aren't as great. The asset protection is almost as good, but not quite as good. But your time frame to be able to access it is a little bit closer than superannuation, unless you're in your sort of 50 plus age bracket.
Mm-hmm. Yeah. Andrew, one of the things that I wanted to point out, so we talk a lot about asset protection, and obviously we think about that in terms of our occupation, but as business owners as well too. But when you look at the probability of not necessarily a business failing, but a business failing and then owing money to people versus a relationship breakdown. So relationships or marriages, 50%? There's the number. So I think and this is completely untested without any numbers behind it, but I think the probability of
stats.
I think the probability of a relationship breakdown that's going to result in your assets being divided is greater than somebody starting a business and then owing money to creditors, right? So the point that I'm trying to make is really I think the personal situation that you find yourself in and the spouse that you end up with is probably the greatest determining factor on protecting your assets. And the second thing as well too is we've spoken about binding financial agreements before, where that is, and not necessarily as an asset protection mechanism, because you'd still separate your assets in this instance, but what it is, it's an opportunity to formalise a contract that basically says, in the event that our relationship breaks down, A, B, C, and D happens. You get these assets, I get those, or the assets that I had coming into the relationship stay with me, and vice versa. I think we can't understate the personal aspect of it, because I think that's probably the biggest risk for most people anyway, in terms of asset protection.
Yeah, absolutely. So binding financial agreements and making sure that there's a mechanism in place that will determine what's going to happen in what instance really is what it is.
And hopefully you stay with your spouse.
Yeah, absolutely. Well, that's so maybe the best asset protection you can have is to be the best spouse you can be.
Stacey, did you hear that?
Yeah, exactly right.
Public service announcement.
And I think an extension of that is also when you're talking about your business. Mm-hmm. So you're talking about, things like key man insurances. So if you've got, an employee who's, holds a really important relationship with, key contractors or key people within the business, and if they were to be sick, injured, or pass away, then it would mean that there would be significant implications to the business, and there'd be a period of time where the business would miss out on revenue, and what would be the implications of that. So looking at, key man insurances to make sure that key people within the business, or if something happens to key people within the business, there's some money flowing in order to be able to cover that. Making sure that you've got buy-sell agreements. Yeah. So, if something may not happen to the business, but a business partner may, touch wood, pass away, or they might be permanently disabled. What does that mean to the business? What does that mean to their shares in the business? Does that then pass on to, a spouse or kids, and all of a sudden you're in business with someone that you don't necessarily want to be in business with? do you have the ability to pay them out and purchase their shares in the business? So again, another topic in itself when we're talking about this, but making sure that all of your buy-sell agreements, your key man insurances, all of that stuff within the business to protect yourself from something that may not necessarily happen to the business is really important, because it can sometimes be dominoes. Sometimes it's, something happens to one person, which then impacts the business, which then impacts all of their personal assets. And so the more stop losses that you can have, the better off that it's ultimately going to be from an asset protection side of things. And personal insurances as well, Bills.
Yeah, personal insurances. I mean, we've spoken about that multiple times on the podcast before, but sort of thinking back to what I was sort of describing with the relationship breakdown, the probability of something happening to you, and thinking through how do you protect that scenario to then protect your assets. I think personal insurance is as well is a consideration, just to try and protect the financial loss that something does happen, illness, injury, loss of income, you name it. So I think that's a fairly straightforward one. Ultimately, it's a really complex area. I think we say this each and every time we're on the podcast, but it's something where you need to get advice before you enter into something to prevent the probability of making a mistake or reducing the probability of making a mistake. Get advice because if you get it wrong, depending on the magnitude of it, it can be quite severe.
Yeah, absolutely. Yeah. And you want to consider all aspects. You want to consider the tax. You want to consider the wealth. You want to consider the risk. I mean, it is multifaceted, and there are individuals that specialize in all of these individual areas. So the more that you can collaborate and have these people sitting around the same table and talking about your situation and what's going to be best for you, the better that it ultimately will be.
Andrew, well said, well summarised. Thank you for today's podcast.
Thanks, Bills. Always a bit of fun jumping on the podcast and sharing some of our knowledge. So hope that you all got some value out of that one. And if you did, like, subscribe, and we look forward to catching on the next one.
Thanks.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaridis and Andrew Nicolou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.